Let's focus on PPC, which was founded in 1892, and it is South Africa's largest cement producer.
So my surprise was that this one wasn't the largest market cap in the sector, so that tells you a story in a way. The business strategy has shifted, and it's really now focusing very aggressively on becoming the leading cement producer across the entire continent of Africa, and we're talking about expansion into countries like Botswana, Zimbabwe, Rwanda, Ethiopia, and so on and so forth. In addition to,
but we have seen a muted performance from PPC over a relatively long period of time. Market cap 7.9 billion rand, PE ratio of 9, dividend yield here of 4.3%. Let's just look at that share price graph to get a sense of what I'm talking about.
Actually, if you looked at a 10-year share chart, it would look the same. So it was at its nadir back in 05, 06, 07 when it reached about 50 rands a share, and since then, I'm sorry to say, it's drifted
It just hasn't
sideways.
delivered value, and you've got to unpack that, Chantal, for us.
Well, I mean, these guys have been spending a lot of money on their expansion into Africa. They've raised a whole lot of debt. This company is very indebted at the moment, and that scares off shareholders to a certain extent. You also had the new entrance into the South African market, which also spooked investors somewhat. And then you had the problem with these Pakistani imports. Recently, tariffs have been raised, so that shouldn't be too much of a problem anymore. And the weak rand will also be supportive of local manufacturing and cement rather than the imported stuff. But still, I mean, it isn't a bad company. Perhaps it's just a question of how long it will take for that growth to come online, relative to how long are we going to see 2% growth out of this thing.
Chantal speaks of the heavy debt pile that this company is facing. And again, it's about how long is it going to take to unlock value for shareholders. A lot of patient shareholders been waiting a long time for this one.
Look, it went to very dizzying heights in the construction boom of 05, 06, 07, because there was the sense that we were seeing a lot of commodity-linked mining expansion. There was also all of the infrastructure building ahead of the World Cup. Everyone got very excited. Those were the heydays. And also they found themselves in a sort of market-dominant position in both the Western Cape and the Gauteng market. Since then, we've had soft cement demand. The programs, even the power stations, which used a lot of cement, are sort of ground onwards. There was a bit of a management debacle, remember, with Ketso Gordon coming in, falling foul of the board, being shunted out. Look, Darryl Castle is an experienced investment-oriented guy. He came from the asset management industry. And I like the strategy because that was what Ketso set the sales for this Africa expansion.
Have you owned this one? Because we don't own it in our stocks portfolio.
We have owned it in the past, but not in the portfolio, and not even in ordinary client portfolios for nearly 10 years.
Do you own it?
No, it's exactly the same. Yes, it's so difficult to call this one because you want to get involved in that long-term growth story, right? But it's a risky story. It is.
It depends on how much risk appetite you have at the end of the day.
What they need is a period of sustained higher than average cement industry growth. And that, unfortunately, is a long range kind of cycle which comes and goes. So for a long while, it's going to be fairly heavy sledding. And as we've alluded to a couple of times here, there's been a lot of new competition in the market. So there's been expansion by competitors like Lafarge. There has been the entrance of Sapaku. There's another Chinese consortium which operates, I think, as Capricorn out of Brits.
So you've also got that competitive element.
Yeah, and
really
unfortunately what happens then is that the big construction customers then can do very good deals, and then the big retailers like the cash bills of the world can also do very good deals, so the margins get heavily squeezed.
Your margins are compressed.
And
hot or not? You want to add, before you call it another, you were going to make another point.
Yes, another issue that PPC faces in the near term is that it's very exposed to South Africa right now. Its assets are very old, so it's very expensive for them to make cement relative to their competitors, and that margin squeeze will probably be an issue until they get some new supply online. So coming to your question about hot or not, long term, very long term, cool, let's do it. Short term, have to go for
not hot. You're giving not hot. Paul, not hot or hot?
I think that's right. I'm afraid it's still in that point in the cycle where there's not enough clarity to drive high returns, so not hot for the moment.